Welcome to Fixated, the Fixed Income Podcast. I'm your host, Elizabeth Moran, Editorial Director of Fixed Income News Australia. Join me as I talk about the latest news, views and education in fixed income investment. I'll be joined by industry experts from Australia and across the globe. Welcome. Today I'm delighted to have Thomas Poullaouec, who is Singapore-based Head of Multi-Asset Solutions Asia Pacific at T. Rowe Price, join us. Thomas, thank you so much for taking the time for this interview. Let's start at the top with your macro view. Do you consider a soft landing scenario is still in play?
Yeah, thank you, Liz, for having me. So regarding the soft landing scenario, yes, this is still my base case. I think everyone has been pointing towards some economic data that has been slowing down, but I would argue that they are not rolling over. So, for example, in the job market, when we see the last print in the US, about 140,000 jobs being created for the last month, it's about equivalent to what we were adding in terms of jobs pre-COVID. So if you look at the period 1950 to 2019, the average monthly print was around 130. So I'm not saying that 140 is that bad. It's slowing compared to the previous job prints that were pretty solid, but it's not completely rolling over. Two other data points that I use to really giving more comfort about that soft landing scenario is, number one, retail sales are still pretty healthy and solid in the US, and we know that the US economy is all about the consumer. And the second one is try to have a GDP estimate in real time that is produced by the Atlanta Fed. And this GDP now, as we call it, is about 2.5%. So to me, this is not a sign of a recession. So with all that, I agree that a recession ultimately will come. It's always like that, but there is no credit cycle that is really exuberant to justify an imminent end of the cycle. And someone told me one day that you sound smarter when you are bearish. So I might not be sounding too smart today. I'm an optimistic, and I think this cycle has more to come.
Great. That was one of my questions. Does it have more to come? So you do, however, expect the Fed to cut this month. Is that right? And what's your forecast for the Fed and rates there?
So, yeah, I think the Fed realizes that they have a window of opportunity to ease some of the monetary conditions. So you have inflation, which has been slowing down. You have the job market, which has been slowing down, as I said before, but not rolling over. And this gives an opportunity for the Fed to reduce the tightness of monetary conditions. But having said that, I don't really reconcile the amount of cuts that the market is pricing in over the next year or so. The market is basically pricing in about 10 cuts. And what that means is that that will lead to a yield that will be much lower than what is required given the economy is still muddling along. So I would say I'm not expecting as much cut as what the market is pricing, and perhaps 3 by the end of the year, and maybe another 1 or 2 early next year, but that might be it.
So then are you seeing the neutral rate about 4% or just under 4%, 3.5% to 4%?
Yeah, everybody is talking about 3.5. I think it's about right. I would say perhaps a bit higher this time around. What we have done in terms of research is that we found that if you look at the real rate of growth over the past decades, and in fact we are trying to compare the new regimes that we are in compared to the previous regime. So, for example, before between the global financial crisis and COVID, where you have very low rates. And that was a bit abnormal to us, because if you look at other regimes prior to the global financial crisis, the real rate of that was about 3%. So I think we are going back to that type of environment, and typically the neutral rate would be that real rate plus a bit of inflation on top. So I think we are there at 3.5, 4%. What that means as well is that if you think about the environment when the Fed is cutting rates, you have two types of environment, basically. One is during a recession, where you have a lot of rate cuts. But you have another environment, which is more the soft landing type of rate cut. And our research will show that it takes about 7 months on average for the Fed to cut rates. And they typically reduce rate by 25% from the peak. So with all of that, you could estimate that if we are in a soft landing, as I said, then the Fed cut could be over by the end of June next year. And we could be at a rate about 4% or slightly lower.
Great. As the US election draws near, are you positioning for a specific outcome, or do you have a more pragmatic view on what will happen?
So first, it's a close call. So it's very hard to predict one way or another. So you have to be quite nimble around that. But I would say historically, we found that elections don't matter that much. If you look at different countries and even in the US, I published a paper with my colleague Nathan Wong, and we studied basically 100 years of data where we compare the performance and the risk of markets during election years or during other years. And what we found is quite telling. So number one, on return, we found that it's better to invest before the election than after. So during an election year, you have better performance 3 months prior to the election than after. I think it's more about politicians are pretty good at promising something. So that's how the market got excited. But then after the elections, there is a bit of disappointment. The second thing is about risk and volatility. Surprising to me is that the volatility during election year is typically lower than in other years. So it's quite counterintuitive. People expect that around elections you have higher volatility, but the data is not supporting that. Having said that, you have a meaningful difference of volatility when it's the incumbent party that is winning the election, or when you have a change of leadership. So when you have the stability on the incumbent party winning, then you have a much, much lower volatility profile. But this is the opposite when you have a change in power. But what we found as well, looking at this data series, is that unfortunately, election years happen a lot during recession years. So there is a lot of overlap between election years and recession years. And typically, that's when you have a change of leadership as well. So the volatility is associated not necessarily by the change of leadership per se, but by the recession or the economy that is doing badly today. So I would say, based on history, I don't think we should spend too much time on election. Having said that, this election is particularly important on two fronts. One, taxes, and second, on trade. So taxes, definitely the two candidates are on two different paths regarding corporate taxes. One wants to cut, and the other one wants to raise taxes, but it's not as meaningful as the first Trump presidency. So I would say the impact here could be a bit lower. And the second aspect is tariffs. We know that Trump, if he gets elected, would like to put more tariffs, especially against China. And to me, that will be a wild card. If we are talking about 60% tariff, that would be extremely bad for Asia and potentially the rest of the world. So my base case of a soft landing could be in jeopardy if we see a Trump wins and tariffs being put in place.
Thank you. That's really insightful. I'm processing it all.
Yes.
This is really good. Can you perhaps just give us a broad rundown on what you see playing out for the US, Asia, and Australia on the macro front for the next 12 months?
Yeah, I think I covered the US already. It's more a muddle through scenario. In Asia, of course, the big economy is China. I would say my base case is quite bearish on China. The amount of deleveraging process that they need to go through is quite significant. And unfortunately, policymakers are not reacting enough with stimulus measures that could counteract this deflationary process. So if you think about it, you have 61 million of houses which are there and not occupied. So there is an excess build of 61 million of houses. So it's a lot of houses that needs to be found a place, basically. So find a buyer. So there will be a long deleveraging process. And for that, you need to have a lot lower yields to accommodate that deleveraging, and yields are still at 2% in China. And if you remember, after the global financial crisis, most of the economy went to yields at zero to accommodate that deleveraging. So I think we need to see more forceful response from policymakers to really see China turning around. On Australia, I'm also quite bearish on Australia, to be honest with you. Two reasons. One is that the previous support that we got from the government and immigrations are fading. So they are still there, but they might not be as strong going forward, especially if there is a change of leadership next year in the elections. And the second aspect is, of course, as I said, China. Iron ore can definitely go much lower if we see China not building as many houses as they used to, and this is very likely to be the case. So iron ore could go much lower, and in that case, that could also have a meaningful impact on the Australian economy. So net, I see Australia not as lucky as it used to be in the past.
Can you talk a little bit about Australian interest rates and markets? Because obviously, with our cash rate, the Reserve Bank didn't hike as much as other developed nations, and there's still very slight possibility, I think, of a rate hike here, but no talk about cuts. Do you have any view on Australian rates at all?
Yeah, I think it's really an interesting development that we see from the Reserve Bank of Australia is that the RBA has been quite shallow and prudent in the hiking cycle, but in a way they now didn't build a lot of buffer to help the economy. And what that means is that inflation, especially wage inflation, is still relatively high compared to their expectation and where they would like to be. So this gives them a pause for this cutting cycle to start. So what you will need to see is wage inflation to go lower to give really the RBA the green light to cut rates. We are seeing some leading indicators pointing in that direction, but I don't know if that will be that quick and we will get a first cut this year. So my base case is that the RBA is more hawkish than the rest of the central banks. As you said, the minutes also indicated that a hike was discussed. So it's definitely not ruled out, and that goes completely against the trend of other central banks. So I would see in terms of rate trajectory a bit more of a stability from the RBA compared to easing conditions in other central banks. So what that means for interest rates is that I would see interest rates in Australia moving higher, especially on the long end. I think we are at the bottom of the range right now, and I would expect interest rate to move higher. I have the same view, by the way, on the US. So that means that I would see long-term interest rates to move higher to reflect that no recession can.
So I wanted to, obviously you're a multi-asset strategist, but I wanted to drill down on your views on fixed income in a moment. But can you just give us your views on the major asset classes? And particularly, do you think the equity markets have further to run?
Yes, I do. It's not a straight line, and perhaps everyone has to reset their expectation about what equity market should deliver, especially US tech. I think some investors might have been used to double-digit return, 20%, 30%, or even more, depending on the stocks that you own. I think what we could see going forward is that earnings are still expected to be quite strong. And especially in the US and Japan, you have close to double-digit returns or high single-digit expected growth of earnings. And that should support the equity market. But again, the total return of equity might just be high single-digit and not double-digit like in the past. So it's more resetting expectation. I would say if I have to compare, as I said, Japan and the US would be my favorite market. Emerging market is a bit of a mixed bag where China could be an underweight, but you have other spots which could be preferred, like in Latin America. And finally, Australia is an underweight because at the same time you have valuations which have been quite high and higher than they have been historically. And earnings are and forecast of earnings are very low relatively to other developed markets. So I prefer to, I acknowledge that you have high valuation across the globe on equity, but at the same time, rate cuts can limit the downside of the impact on valuation and price multiples. But on the opposite side, I like to be more exposed to markets where you have clearer earning growth. And unfortunately, Australia is not one like that.
That's okay. You can give us bad news. It's all right. Are you fully invested at the moment? Or are you hanging on to cash for better days in your portfolios?
I still have some cash, but that's not to really expect more to be deployed in equity per se. It's more to reallocate to bonds at some stage. I think I still prefer when you have inverted yield curve to have more cash in the portfolio. And as I said, given that I am more on the no recession camp, I do expect yields to move higher on the long end. But at the same time, our research has been showing that when you are in a Fed cut cycle, typically bonds outperform cash even when you start with an inverted yield curve. So this is really an area that my view may change by the end of the year, where I might find better opportunities to redeploy the cash into bonds. Because I do expect that bonds, when you have a recession, ultimately, again, I don't think this is imminent, but a recession will come. And bonds do well when you have a growth shock. Bonds didn't diversify equity when you had an inflation shock like 2022, but I'm expecting bonds to diversify equity risk when you have more growth risk. So at some stage, I would like to benefit from the rise in yields, which I expect to deploy more capital into government bonds as
well. Private credit is a growing sub-asset class here in Australia. Have you got any thoughts for investors looking to invest in that market?
Look, private credit is, to me, it's quite interesting because it's filling a gap from the banks, basically, which have not been providing as much support to especially small companies or companies which are a bit more in trouble. So due to post-global financial crisis regulatory constraints. So you have private credit that grew from that, and that is providing again something that the economy needs, and that's perhaps why we see also default rates to be that low, because private credit is helping to be a bit more nimble in terms of refinancing condition and so on. But I'm a bit worried when everybody is telling me that their priorities this year is to invest more in private credit. And this is definitely a trend that I have seen not only in Australia, but in other places in this Asia Pacific region. So what I would say is that there are two camps. If the decision is made because you want to increase your income and yield level of your portfolio, and you are okay with the liquidity conditions, you hire a manager that can do very strong due diligence and credit analysis, I think that makes sense. But if you are a manager, a client that is buying in private credit because you think you will hide the volatility because it's private, so it's not day-to-day pricing, I think that's the wrong reason. What we did in our research is to show that if you have a typical portfolio, let's say 60% in equity, 40% in bonds, a balanced portfolio, and you want to invest in private assets, what we recommend is to basically unsmooth the data. So to, instead of having a straight line because there is no daily pricing, to recreate through a mathematical process some volatility, which makes this asset class more comparable with equity or fixed income. And when you do that, you find that your optimal allocation to private assets, including credit, private equity, real estate, could be about 15%, 15%. So if, again, the allocation to private credit is coming from 0 to 5%, that makes sense. But if it is going beyond 15%, including private equity and real estate, I would start to be a bit concerned for a balanced portfolio.
Excellent. Thank you so much. What risks are on your radar right now? What are the main risks you're considering?
I think the one that I touched on is China. Unfortunately, the policymakers in China are not yet deploying enough stimulus to really turn around the economy. So that's something that is still a concern. I'm looking also at the state of the consumer in the US. Again, as I said, so far so good, but definitely I will pay attention to the job market. So jobless claims, which is a weekly data that we get every Thursday, is something that I pay a lot of attention to. So if it goes above 260,000, that could be a warning to me. And the last but not least, unfortunately, is geopolitical risk. We have two wars that are taking place in the Middle East and in Europe. And at best, what we can expect is a status quo. And unfortunately, the risk of escalation is still there. So we should not undermine also the possible spillover on commodity or even on consumer confidence in Europe.
Just because you're closer to China and Asia, we're part of it, but we're a bit further away. Do you have any views on the South China Sea and any escalation between China and Philippines or Taiwan?
Look, I think it's also a risk that is there. And again, sometimes we can see that from a politician perspective, trying to divert the attention of the country to an external conflict can be a tactic that has been used. So I don't think we are there as far as China is concerned. I think China is definitely looking more inwards in order to ensure common prosperity and equality in the population. So I would say I'm not expecting that as a short-term risk, but definitely something that we need to pay attention to. But it is not a high probability for me.
Just quickly now, starting to wrap up a little bit, can you tell me, are you broadly positive, neutral or negative on the following asset classes? And I'll run through them slowly. We'll talk about each one differently. And of course, there's different time spans within the asset class, and I appreciate that. But let's start with US government bonds, or your view there.
Yeah, so let's assume that my views are for the next 6 to 12 months, and that will be my time frame. So first on US government bonds, I'm negative. I think there is really a case, especially if you have no recession, that the market has been over optimistic about the amount of Fed cut that will come in the system in the next 12 months. And I would expect the expectations to be revised lower, so a minimum number of cuts, and that will lead yields higher as well. So I'm negative still for and that's perhaps my highest conviction, to be honest.
Okay, great. Australian government bonds.
Same. I think there is a correlation between the long-term yields that is at play, plus The RBA is more hawkish than because of inflation. So at least in the short term, I would say we are at the bottom of the range. I would say my view for government bonds in Australia might be a bit more tactical, a bit shorter term, because as I said before, I don't think the state of the economy is as strong in Australia as in the US. So perhaps going forward, there would be a bit lower yield, but for until the end of the year, I would say I see yields moving higher.
Global credit.
Global credit, it depends. We have some clients that cannot invest in high yield or EM debt. So in that case, I'm okay to have investment grade credit. There's still a bit of a spread, but definitely duration risk is quite high. So I would say neutral in that case. But if you have the opportunity to invest in higher yielding sectors, I would be underweight also investment grade, and I would prefer to go for lower quality bonds at this stage, which can offer higher yields and a shorter duration.
High yield.
That leads to my overweight. So I've been overweight high yield for a long time. Perhaps reducing that position slightly as spreads have been compressing. But high yields is still generating a nominal yield on about 6 to 8%, depending on what type of indices you are looking at. And the quality also of the high yield space improved quite significantly. So that's, as I said, the amount of leverage is not as large as in previous credit crisis. So yes, there will be refinancing happening in 2025 and 2026, but I don't think this would be as much of an issue as in the past, given that we are facing a higher quality index for high yield.
Emerging market sovereign.
So on this one also, it depends what we are talking about. If it is emerging market sovereign local currency, I think I like that space, but perhaps being mindful of the currency risk as well. There is perhaps a window of opportunity where the dollar might not be as strong as it used to. So some currencies might do better, especially if the carry trade. So the difference between higher yielding currencies and lower yielding currencies is back. So the likes of Latin America, for example, as I said before, Mexican bonds, Brazilian bonds, they might do better. But overall, if you are talking about EM debt in US dollar, it tends to have higher duration risk. And on that one, I would be a bit more cautious. So a bit more constructive on EM rates, because we have seen that central banks started to cut rates in emerging market before the Fed. Inflation is not as much of an issue, so I can see yields moving lower, and you have a lot of carry opportunity there.
I was going to ask you about emerging markets corporate as well, because there's some massive corporate, companies that are domiciled in emerging markets.
Yes, this is one of the areas I think that is underused by investors in terms of benefiting from high quality companies. Because let's face it, if you are an emerging market companies and you want to issue debt, you have to be quite high quality to attract capital when you compare with other markets which are more used to issue debt and perhaps more relaxed in the credit quality. So you tend to have higher quality in EM corporate, and same, the duration profile is quite close to high yield. It's not as much in terms of nominal yield, but it's quite competitive. So volatility-wise, I think EM corporates makes a lot of sense, and that would be a clear overweight.
I'm not going to ask you about private credit. I feel like we've covered that. But I did want to just touch on Japan. I mean, with your expertise, your Asian expertise, if you can just talk us through the Japanese markets and what you're witnessing there, that might be really great.
Yeah, I will make two comments on Japan. First, on the BOJ and the impact that it had on markets, and second on the equity market, which is one of my favorites for quite some time. So on the BOJ, I think it's quite telling when you look at the VIX, which is an indicator of volatility in the US. At the beginning of August, you had a massive spike in the VIX number. It went to 60 or even above intraday. And if you compare the different episodes in history when you had a similar spike in the VIX, you have three comparable episodes. One was the GFC, so global financial crisis. Another one was the tech bubble. Another one was COVID. And the last one was BOJ hiking by 15 basis points. So I don't think you can really compare all of these events. And I think it was really a extreme positioning, short yen, and perhaps lack of liquidity at the beginning of August as well. So you had really technicals which were quite poor, and that created that unwind of positions all at the same time. And when you have volatility starting to spike, people are getting nervous and they are selling. So I think that was a bit of uh, a one-off event and not a systemic event. Yes, the BOJ, the Bank of Japan, will continue to hike rates. Inflation is definitely back in Japan, and they will adjust monetary policy, but they will be very gradual. And if they do by 15 basis points each time, this is not the end of the world. So you still have a big gap between the Bank of Japan rates and the rest of the central banks. So that's one. I think people are perhaps got too nervous about the hikes that we got at the end of July. On the Japanese equity market, I think it's a story that is started perhaps 10 years ago when you had the so-called Abenomics, which was trying to really change corporate governance at the Japanese company level, where historically Japanese companies used to have a lot of cash on their balance sheet and didn't really favor shareholder returns. And this has changed. We can see that buybacks, the amount of buybacks of dividends payments increased quite significantly in Japan over the past few years. You have really, in terms of return on equity, the Japanese market is the only one being competitive with the US for the developed market. So you really have a very strong forecast there and strong support from corporate governance. And in terms of forecast, earnings growth are still positive given that you have inflation back into the system and a weak yen still, even at 140, 145. That is still helping the economy on the export side. So I still like Japan for these reasons.
Now, it just occurs to me some of our Australian listeners might not be so familiar with T. Rowe Price. Can you just talk us through a little bit about the company, your research capabilities, some of the products you might have here in Australia for our listeners?
Yes, sure. So T. Rowe Price is a US-based company that was founded by a gentleman called Thomas Poullaouec in the 1930s. And since then, it grew globally to a franchise that is now managing above 2 trillion of Australian dollar of assets. We cover everything from equity, fixed income to multi-assets. We also have an affiliate managing private credit with Oak Hill Advisors. So we have the full service available for institutional clients. For retail investors in Australia, we have a range of funds which are available, which cover global equity as well as fixed income. And in fixed income, it can be a range of high yield, as I mentioned before, but also some strategies which can be a bit more diversifying. So some fixed income strategies that react well when you have a shock in the economy. So we try to be a bit more targeted for the retail investors in Australia, focusing also on global equity, growth, impact, and more concentrated version of our research. But as you said, T. Rowe Price has been built on a very strong research platform. Everything we do is active. And when I joined the company 7 years ago, I was quite amazed by the track record that we had, not only for the last 1 year, but 5 years, 10 years. So we continue to deliver top quartile performance across a range of strategies. And that's what our clients like. So,
Thomas Poullaouec from T. Rowe Price, thank you so much for your insights. Your Asian insights are so valuable. I've learned so much today. Thank you for joining us.
thank you very much for the question, Liz.
Thank you for joining us this week on Fixated, the Fixed Income Podcast. Still hungry for more fixed income news, views and education? Then visit fixedincomenews.com.au and don't forget to subscribe to our newsletter to have the latest news delivered right to your inbox. Thanks again for joining us. I'm Elizabeth Moran and we'll see you next episode on Fixated, the Fixed Income Podcast.